Hi, it's Jason Rogers here, CEO and majority owner of Brighter Utilities. And I wanted to talk to you in this video about the differences between how Brighter Utilities looks at investment opportunities versus that of some of our larger competitors in the private equity world. I'll start by saying simply that we are willing to go after acquisition targets that are just a bit smaller than what a private equity firm would normally look to target. There's a few reasons for this. Number one is we can get these acquisition targets at 3 to 4 times earnings, which is an exceptionally good earning ratio to be buying these businesses at. And that's really where it starts for us. This allows us to get really high rates of return on the equity that's injected into these transactions because we can apply a greater amount of debt or leverage onto these transactions and use less equity. And it really means we can get an exceptionally high rate of return on that equity invested. So that's really the first thing. Now, mind you, there is a bit more risk with these transactions. I want to be clear. You have to get your hands a bit dirtier. I'm not normally dressed like this when I'm involved in the day-to-day of overseeing management, making sure that we have the right managers in place, making sure that operations stay steady after we make these acquisitions. It's not to say that what we do just is some miracle solution. It requires a lot of work, and there can be complications if you don't handle these acquisitions with care post-close. But you won't hear of private equity groups that are buying businesses at 3 to 4 times earnings. And that's something we can and do actually execute on a fairly regular basis. So that's one thing. Now, with that being said, we also are willing to look at acquisition targets that, again, have a little bit of that funk, you might call it, that will dissuade some of the larger players from competing. Maybe there's a owner that's quite involved in the day-to-day operations. Perhaps there's, let's just say, SOPs that aren't fully optimized or customized. Perhaps there's antiquated systems, a lack of software that's implemented into the business. We look at these items, let's just call them, as opportunities. And that's not to say that other larger players don't see them as opportunities, but usually they're looking for a slightly more developed asset. And actually, funny enough, this is what we do. We develop the asset, we cure the asset, we build these systems in play. And by making a number of these types of acquisitions and by putting management in place and putting in SOPs and putting in, more sophisticated softwares and things of this nature, and then obviously building these companies over time and making a number of acquisitions over time, we continue to build the portfolio value and the equity value of Brighter Utilities so that we're buying these businesses, as standalone acquisitions at somewhere between 3 to 4 times earnings. We're putting in SOPs, we're putting in management, we're putting in software, we're growing the businesses. And even just these individual businesses, if sold alone, would be able to sell for 4, 5, or 6 times earnings by the time we ultimately exited if we were selling just one asset. But of course, we're not going to sell one asset. When we ultimately exit, we'll sell all at once and create a very substantial arbitrage on the equity, right? So we bought a bunch of these businesses at 3 to 4 times earnings. And then, in 4, 5, 6, 7, 8, 9 years from now, we could be exiting at the portfolio level when we sell all at once for 10, 12, 13, even 15 times earnings. So there's a huge arbitrage that we're creating there. And during the hold period, because we're able to use a lot of debt and not much equity is injected because we're buying these businesses at 3 to 4 times earnings, we're able to get a high rate of return with regards to the cash flow during the hold period to keep things interesting for both ourselves and our investors. And so this is really our thesis in a nutshell. We're willing to get our hands dirty. We're willing to get involved in opportunities that others might not see. And this is really what excites us. And this is what we look for. We look for businesses that are solid, that are stable, that have great fundamentals, but that could be cleaned up a little bit. And that's what we love to do. All of that being said, if you're interested in getting quarterly cash flow, equity upside, as well as an investment opportunity that has absolutely zero management fees, then consider investing with Bright Utilities. We'd love to work with you. We love working with our investors, our accredited investors. We love writing them those checks, that quarterly check. We really love taking care of our investors, and we'd love to have the opportunity to speak with you a bit more about what it might look like to work together. So if that intrigues you, go to brightutilities.com, fill out your information or enter your information, and we'll be able to, after the fact, get on a call and go from there. Thanks for watching. We'll talk to you in the next one. Bye-bye.